This scatter plot shows profit and loss versus trade duration. While high win rate claims are usually dismissed, this dense clustering of green dots near the zero duration line presents an engineering problem. The system routinely secures positive P&L in minutes, keeping red losses sparse. This bar chart displays verified long-term account data, documenting an average win rate of 78% across multiple market conditions. The central question is mechanical. How does a trading system engineer this specific distribution of rapid, highly probable wins while surviving the noise and volatility of intraday markets? This outcome stems from a strict layered architecture built on statistical boundary conditions, near-future pattern recognition, and emotionless execution agents. A common misconception in algorithmic trading is that the ultimate objective is a fully autonomous, hands-off system. Fully autonomous systems frequently fail because they lack high-level contextual awareness. When sudden macroeconomic shifts or unexpected news events shatter normal market conditions, rigid algorithms continue executing into the turbulence and rapidly drain capital. The alternative approach is called vibe trading. Here, a human operator provides the macro-directional intuition based on context, but the human never manually executes the actual trade. Human manual execution is a structural bottleneck. We suffer from slow reaction times, we suffer from slippage and revenge trading. Slippage is the difference between your expected and actual execution price. Revenge trading is the psychological trap of increasing position sizes out of frustration. To achieve a 78% edge, the architecture must isolate the human operator to strategic selection, while completely delegating the micro-execution to an emotionless machine. The first pillar of this system is the Graphic Language Model, or GLM, operating on a real-time 1-minute chart. A graphic language model is an AI system that processes and predicts visual chart patterns rather than interpreting text. The AI continuously scrapes vast historical databases, analyzing millions of past market structures to find the exact historical sequence that matches current live price action. Using this match, the GLM instantly draws a projection of the next 5 bars directly onto the screen. The system restricts itself to the 1-minute time frame for a specific reason. The system utilizes a 20-period, 2-standard deviation Bollinger Band. A Bollinger Band is a technical indicator plotting a simple moving average alongside upper and lower bands, calculated by standard deviations to measure volatility. The underlying assumption here is that intraday prices do not follow a normal distribution. Market mechanics are bimodal, clustering near the extremes rather than hovering at the mean. The mechanical trigger for a trade is highly specific. It requires the precise moment when the AI's 5-bar projection perfectly aligns with the extreme limit of the upper or lower Bollinger Band. Hitting a 2-standard deviation limit represents roughly a 95% statistical boundary. At this exact threshold, the probability of an immediate mean reversion spikes. The AI projection acts as a secondary filter. It prevents the system from buying into false breakouts or trending markets that simply ride along the outer bands without reverting. By requiring both a visual pattern match and a mathematical extreme to align simultaneously, the system filters out the noise and constructs a mathematically superior counter-trend entry point. Once the human permits the trade direction based on these confluences, the AI agent assumes complete mechanical control of the execution. The agent relies on the instantaneous placement of dynamic limit orders within the market book. A limit order is an instruction to execute a trade at a specific price or better, eliminating the slippage inherent in standard market orders. If the price temporarily moves against the initial position, the agent mechanically initiates an averaging down protocol. Averaging down is the strategy of buying additional units after a price drop to lower the overall average cost of the position. The agent executes this second buy order at the next calculated statistical support level. As the new position is added, the agent instantly recalculates the required profit margin. It lowers the take-profit limit order to match the new, improved average entry price. This relentless adjustment harvests micro-volatility. It forces the position to close the exact microsecond profitability is achieved during a pullback. A human trader physically cannot calculate new average prices, adjust risk parameters, and move limit orders fast enough to execute this manually within a 1-minute time frame. The agentic execution layer transforms a theoretical statistical edge into realized P&L simply by outperforming human mechanical speed. This raises a mandatory counterargument. What happens when the market ignores the statistics, trends aggressively, and refuses to revert to the mean? This scenario is defined as the 0.3% statistical tail risk. These are market events equivalent to a third standard deviation break, where normal trading mechanics completely collapse. To survive this, the platform enforces its strictest mechanical constraint, a hard limit of 3 to 5 averaging down entries per agent. The protocol dictates an absolute prohibition of a 6th average down attempt. It treats this scenario as a critical system failure state. Reaching this threshold means the predictive model has failed, and the market context is anomalous. Further capital exposure is statistically invalid, and the system executes a hard stop. Beyond identifying market entries, the system serves as a physical firewall, blocking the human operator from committing catastrophic emotional errors during tail risk anomalies. This is the breaking point where human traders often engage in revenge trading and wipe out their accounts. Evaluating this scatterplot through the system's complete architecture, that dense cluster of fast green wins is the footprint of AI agents executing dynamic limit exits. The sparse red dots represent disciplined hard stops, taking a mathematical loss rather than spiraling into a blown account. The complete price on rails stack operates linearly. Human direction triggers the AI 5-bar prediction. The system waits for statistical confluence, which then triggers the agent execution and the dynamic limit order exit. The 78% win rate is the quantifiable byproduct of weaponizing microvolatility while mechanically constraining human panic. The methods behind algorithmic market operations are evolving. Fully autonomous black box systems that strip humans out of the loop struggle with high-level contextual changes. A competitive edge emerges when pairing the contextual intuition of a human with the relentless mathematical execution of an AI agent. Platforms like this facilitate the transition from an emotional, manual operator to a disciplined systems architect. In modern financial markets, the ultimate advantage goes not to the fastest human, but to the human who best delegates speed and discipline to the machine.